Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Stewart Heath, an entrepreneur and leader with over 35 years of experience transforming organizations into efficient operations and being a real estate investor for over 20 years. And Heath's experience includes commercial and multifamily development, construction, and management. And during the GFC in 2008, he learned many lessons on the best practices of holding and operating real estate. He now applies this wisdom he gained to the syndicated offerings his firm, Harvard Grace Capital, have brought to market. So thank you so much for coming on the show today, Stewart.
Thank you for having me. It's quite an honor.
So please give us a background on yourself, both personally and professionally, prior to getting involved with real estate investing.
Sure. Well, I'm a CPA. My dad was a CPA, and when I went to college, well, that sounds okay. I'd had a pretty good life yet, and no, I didn't have any idea what all that involved, but majored in accounting, graduated, got a job with back then what was called one of the big 8 firms, Price Waterhouse, and immediately started into auditing and taxes and things like that. And I love my dad, but I've got an entrepreneurial streak that he didn't have. He literally had one job his entire career after college, and with the same firm. He grew up through the ranks and became a partner at what's now Ernst & Young, but back then that was before a couple of other mergers. And while I took a path, I went to Price Waterhouse, and fabulous education for just general business. But as I said, I just had an entrepreneurial streak that I suppose I got from my mother, and so I was trying to be intellectually honest, and so I left Price Waterhouse after 4 years because I wanted to do all these other things, and I didn't want to be doing that on somebody else's dime. And so I started a bookkeeping practice, and which would give me leeway to start other things. So I got out of college in '85, and then right after that was the 1986 Tax Act. Where they retroactively, basically devalued a whole bunch of commercial real estate because they took away a lot of the tax breaks and things of that nature, and a whole bunch of property, hit the market. And so commercial real estate was on the skids for 3 or 4 years after that. And so I sort of came up in my business infancy, hearing that real estate was bad. I would be at meetings with bankers and breakfast meetings and conferences, and well, real estate's bad. And you'd hear bankers say, "Yeah, but we're not loaning on real estate anymore." Oh, okay. That's sort of a universal declaration that the most secure asset in the world was no longer bankable at the time, and so all of that just got embedded, in my brain. But then in my small bookkeeping practice, I picked up a whole lot of real estate entrepreneurs who were making money hand over fist and doing fixes and flips, buying small apartment buildings, doing construction, some combination of all of the above. I had one client that was into halfway houses for substance abuse recovery participants, and they ended up buying a bunch of apartment complexes and then and doing it that way, and built a great deal of wealth through that process. And finally, about the year 2000, I realized there must be something to this real estate thing, and so I started to pursue it, and went out and bought one duplex, and realized, oh, I kind of like this, and then my next deal was 14 duplexes, and after that I started building houses, and I bought a group of condos, and then I ultimately bought all the condos in that complex, and then rehabbed those and remarketed those for sale, and then along, you're the first person I've ever heard referred to as the GFC. It took me a minute to figure that out. Oh, yeah, I remember that. I lived that one. And so, frankly, I built up a portfolio of real estate with a net worth in excess of $10 million, and then it's beginning in 2009, started giving it all back to the banks, and so it hit me pretty hard, because I was doing what some people I think call the equity ladder. I bought this one, and then you wait a year and a half, and refinance that one, take cash out to buy this one, and then buy that one. I just walked it all the way up to a fairly sizable estate, and then, as Warren Buffett says, the tide went out. Now we're going to see who's swimming without their trunks on, and that was me. All of that did without reserves, without much fallback, and assuming that everything would just continue to go up forever, and of course it didn't. So that's kind of my story. I got back into real estate after that in about 2020, with Harvard Grace Capital, and we're doing things very differently now. So.
Yeah, it's amazing you're talking about lending in the 80s and lending during the GFC or global financial crisis. And it's something that it always amazes me that banks don't lend when property prices are like low. You know what I mean? It's like, am I the only person that sees this? And you're like, hey man, if everything just went down 20 or 30%, like I don't know. I'm just like, has anybody ever thought of this? It's just, it's an interesting way. And I remember I was, trying to refinance a small commercial property in 2010, and a bank I've worked with just in other businesses, because I was just a small landlord, and they would give me 15% loan to cost. That was the loan that they were going to give me. And like my family had a almost 10-year relationship with this local bank. This isn't a large bank, one of the large four. It was, and you're like, just say you don't want a loan on the property. I mean, it's just like, it's insane. Like I can, it's just like things fully rented, all this kind of stuff, and like loan the cost, not even like what we would, if we could even figure out a value, because it would probably be, you know what I mean? But it's just like, I don't know. It just, they don't loan, then they start up again, and then you find yourself in issues. So
yeah. And the real reason for that probably had nothing to do with you or the property.
No,
it probably had everything to do with regulators that were going to be coming in the next month, and they were worried about their concentration of commercial real estate.
That's probably exactly correct. Yeah, when they did that concentration review, they probably didn't look at any loan to values or anything in depth on the property. You know what I mean? It was just like, oh, you got to get this off your books, or we don't want that on our books anymore. You know what I mean? So, but anyway, a whole banks and lenders, a whole nother episode.
Oh yes, but, absolutely.
So tell us about, I'm really interested in kind of how your investment strategy has evolved over the years, from obviously going through some rocky times in the past, and how you've done it differently. As you said, you're doing things differently with your current company. Like, what's going on there? What are you guys doing, and what have you changed?
Yeah, so lessons learned. First and foremost, you have to prepare for what you don't know is coming. You don't know what you don't know, and so. Big believer in having reserves. We will build in 12 months of reserves into every deal that we do now. Every deal stands alone. That does weigh down returns, because you got a bunch of cash sitting around that hopefully you're never going to need. But that's okay. We've all been there where, you in fact did need it. And had I had 6 months of reserves, I would probably still own some of those assets that today that I had acquired back then. So that's rule number one. And the other lesson learned is just the sheer importance of stabilized cash flow. I listen to the financial media all day long. CNBC is always on in my office, sometimes Bloomberg, whatever. And no matter what, to me, they're all talking about trading. They're not talking about investing. And so I've done a big study on what is real investing, what is good. And so it's really the long term. We invest for the long term, and just my firm belief that stabilized cash flow should be the core of everyone's portfolio. And once you have a sufficient foundation, and that'll be different for everyone, then by all means, go out and do a development deal. Take a little bit more risk. Go out and do a value add rehab deal that will have you know unknown time frames and unknown issues, but that's okay. It's not going to, you should never do a deal that's going to take you down. But having that foundation with which to stand on, that covers everything it needs to cover, that gives you the right to go be a little bit more risky with things. So that is what Harvard Grace Capital is really designed to do, is to provide investors with those stabilized cash flowing assets. Do I want to go do development again? Yeah, I do, because they're fun, they're creative. But at the end of the day, you can be very creative with a lot of boring stuff too. And I literally almost named the company Boring Capital, but didn't. I actually saw PNC Bank running a series of commercials about being boring, and that's really what we're about. Stabilized stuff, long-term tenants, and that's what we're about. Smart use of leverage.
So give us like an overview of kind of what your investment strategy is, like what type of assets you guys are looking for. What are the markets that you guys kind of focus on currently?
So currently our portfolio consists of 4 assets. We sold one off earlier this year. So we are into what I call suburban office. Some people will call that service retail. We're into medical office, we're into retail, and we're into storage. And sometimes we do both, multiple of those in the same location. We bought a medical office a year ago down in Huntsville, and the doctor that sold it to us kept a garage downstairs where he worked on his race cars. And so we just, rather than build that out as office and go out and get 25, $30 a year rent, and I'm going to spend $100 building out. We put storage in there. Had to get a variance to do that, but we were able to get 30 units of odd sizes in there, and we're right in the middle of this medical park, and all medical people have massive record storage issues, and we just got that opened in May, and we're leasing those up pretty fast. So I've got 25% of the build out cost I would have on that space, and I'm going to get the same top line revenue for that once it's fully leased. We expect it to be fully leased by November. So that's how we sort of combine the two. But we like medical office, and I like I say, suburban office.
Yeah, that's a medical offices are great, but I love that value add that you had. That's a very unique value add kind of situation there, where adding storage to medical office, and obviously it all makes sense when I listen to it, but it would be not the first thing I would think of when you're trying to do a value add for a medical office space.
Yeah, it was not my idea. It was actually the idea of the seller's broker, and then independently 4 or 5 people came up to me, and I just said, no, that's stupid. No, that's stupid. And then, one night it's like, maybe that's not so stupid, but then we've executed it. It wasn't easy. We had to get the city of Huntsville to grant us a variance, but we had done a little canvassing and had so much demand from the community around us that they went along with it. And you're not going to drive up to this building and think that there's storage. They were all worried about what's it going to look like from the outside, and you can't tell.
Nice. That's perfect. That's great. Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com. So, it seems to be commonplace for a lot of syndicators to kind of like switch asset classes and focus on different different asset classes during different market cycles, right? I mean, how is it with your company moving from your past, which is in like a lot of multifamily and other, and then construction and stuff like that, going into what you're doing now? And obviously, like medical office is a fantastic asset class. What were some of the reasons for switching and to what you're doing now?
Yeah, I'm a member of some groups that are nationwide, and I always felt like the oddball out because they're all single asset class. They're all in on multifamily, and for one, back before my crash, I had over 200 personal rentals, from duplexes to condos to houses, and I just said that's the nearest definition of hell on earth, to me. And I don't like residential rentals. I completely get that multifamily is the mother, the king of all commercial properties, because it's, housing plows the way for everything else, and so I follow that market. But I also manage everything we do, and I don't want to manage multifamily. I don't mind doing storage. It's a bit retail, but it's awesome. And office and stuff is much more like dealing with my clients as a CPA over the years. So I come to this, from my own personal likes and dislikes. I think multifamily is an awesome class. So, I think the answer to the question is we're doing what we're doing now because there were good opportunities and they're assets that I like. But differentiating from the other people who focus on an asset class, and I don't necessarily think that's wrong. I'm focusing on my own geography, though. So I call it the 840-565 corridor. That refers to two interstates. One's in southern Middle Tennessee, one's in northern Alabama, and anything that's sort of in between those. We love these tertiary markets. We love Huntsville. Anything south of Nashville where everybody's still driving north to Nashville. These are great markets. I don't know the first thing about Phoenix, Arizona. I hear it's great. I don't know the first thing about Dallas or Houston. I got friends down there. Unless I've got Google Maps, I don't know how to get around either one of those places. So I don't know those markets, but I know Huntsville and I know Nashville and I know southern Middle Tennessee. So we are investing in markets that we know. We live here, and we're breathing it in every day. So that was our choice. Again, I don't think anybody else is wrong. This is just the right choice for us.
Yeah, no. It just every investor kind of hones their investment strategy, what's worked for them over the years, and the same thing too. It's like if you speak to lenders and what they lend on, you know what I mean. Certain lenders lend on certain things that have worked well for them and their company, and they do more of it, which is fantastic, and they understand it even more. It's just one thing as an investor with office space, and obviously office space has gotten a bad name over the last few years, and I don't think it's that bad. I want to like kind of break a little bit more into your kind of strategy of how how do you go about finding recognizing and identifying specific office assets and knowing that there's going to be and then seeing what that kind of value add or what can happen to add value for your investors and yourself?
I'm going to answer that two ways. So how we look at office assets is, one, who are the tenants, obviously. And we've already mentioned medical. It's already an awesome class. But even in our first acquisition as Harvard Grace Capital, I'd managed this building. It's in Spring Hill, Tennessee, which is a suburb of Nashville. It is what I call suburban office. So here's the bottom line. Are the tenants consumer facing, or is it just a place for their employees to gather? Because it's that latter one, it's those properties that are having all the kinds of problems. It's the downtown office spaces and or the Class A office spaces in suburban office parks that are having the problem. Those are the places that the employees don't want to go back to. But if it's a dentist's office or a State Farm office or a mortgage company. That's where they meet their customers, and and just like a medical office, you know, they're not going remote. Your doctor's not going remote, and he's not coming to see you. So he has to have a place uh, to put all that very expensive equipment, and he has to have a place that's built out to in order to service his patients. And that's the way it is for most of these places. The problem is, and I love to pick on the media, but the problem is they have declared office is dead. Well, apparently none of my tenants has figured that out. And it's just a stupid statement on the face. Um, there's many subcategories to office. Medical is one of them. Suburban office is another. And yeah, and at the end of the day, you end up back at rule number one of real estate investing, which is all real estate is local. So my building in Spring Hill, there's not another building like it for 10-mile radius. I wish I had 3 more just like it.
Yeah, I think that is a great point about what the use factor is of the building in the sense of how it's being utilized by the firm and how it's being utilized by the customers of that firm that are going to rent it. I never really thought that, but now after going to my doctor's office last week and not finding a parking spot in their in their complex, their office complex, it's makes perfect sense. It all does. It's one funny thing too about what you're saying about the media, and I think I was part of a mentor group, and it is right around 2020, and they were telling me that within a week of Twitter saying that everybody could work from home, right when everything started, right, forever they could work from home. Within a week, they were telling me that a GC that they worked for signed a contract with Twitter to build a new headquarters. So you hear all this here, and then you just don't see what happens behind. And I think you really have to take all that with a grain, because it's like, they knew it wasn't going to last. Obviously, they're not going to sign a contract they didn't even already sign it. It wasn't like something was already in process. So here's stuff like that. You kind of understand exactly what's really happening, and maybe, people thought it was going to be temporary, and that's great. It's great that, you're working and you've been able to work through office space. And are you finding those deals? Is there less competition for it because of what's being said in the market? Or I imagine there's other investors as knowledgeable and astute as you that are there trying to pick up those deals as well.
I am certainly not the smartest guy in the room, and yes, other people have figured this out. And I think in large part because, again, all real estate is local. I'm playing in some very healthy but balanced markets. We have moved from it being a seller's market to what I call a balanced market. In that negotiations are very difficult right now, very tough. But last year we weren't even having negotiations. There wasn't a deal hardly that would pencil. This year we've underwritten many deals. We've had to drop out of a few. But it's a balanced market. There's plenty of lenders, and if it's the right deal structure, there's still a fair amount of investors, in large part because of the deal structure, because of the location, because of the asset class, and so I'm calling this a balanced market. And so, yes, there are many other people that are also pursuing these deals as well, and you win some, you lose some. Going back to that, to your other point a minute ago, back in 2020, retail was declared dead, if you remember. And I was just reading stuff yesterday for this month's newsletter, and what's the hottest asset class so far this year? Retail, and the rates on them are unbelievable. That's because there was a 2-year lag in people doing new retail deals, and now there's not enough space for the demand. So
we probably read the same chart. It's like
probably
the amount of vacancy time between it, which usually from before, and it's like, wow, something else you're not going to read in your, let's just say, mainstream media, right?
Yeah. Whenever somebody references commercial real estate is, well, just turn them off, because it's so much more than one thing. So.
Yeah. So Stuart, as we're kind of ending up here, you gave a lot of knowledge about kind of how you changed your business plan over the years, but from seeing other investors, you've been doing this for decades. What are common mistakes maybe you see other real estate investors make, whether they're new investors, whether they're seasoned investors, and kind of give us like some points on that.
Sure. I think my dad told me the first time I ever heard this, the only way you ever learn anything is the hard way. So, and so fortunately now I've lived long enough that I've learned an awful lot of things. I think most people overbuy. They overpay rather on their buy. And I don't know who said this first, but you make your money on the buy, not the sell. And that's true in your stocks. That's true on your house. That's true in almost any type of investment. And even though you might get an okay price, if you don't work it hard to get the best price, you'll never make as much money on that deal as you would have if you bought it right. So there's an awful lot of number of reasons. People will take a deal rather than the best deal. Perhaps their shop is fee driven. They need a deal. They need to close one this quarter to generate fees. That's something that I'm very fortunate that we don't have that pressure, and I don't ever want that pressure. But there's all kinds of things. But I think that's the number one thing. Are you buying it right? And then beyond that, what's the quality of the cash flows? Because here's my third rule: is whatever business your tenants are in, you're in that business too. Because being a landlord is an extension of credit. You're almost banker like, and we love retail, and there's an awful lot of competition for every retail strip center that hits the market right now. But I passed on one, and it's right next door to one we were trying to buy, and I thought, well, let's get that one too. And then I kind of looked at the tenants and like, nah, they're all second tier. They're mom and pop restaurants. I'm not a big restaurant fan unless they're multi-unit operators. Restaurants don't tend to last all that long as tenants. And so, I didn't like the tenant base, and so we passed. So those are my lessons.
Yeah, that's great. I love on the tenant. We do like a lease audit and figuring out what's going on. Yes. And like you're saying, you really focus more on like credit tenants, you know what I mean? Solid tenants that you're working with. And the same thing for us when we're getting into it. You just have to know what you're getting yourself into and have an idea, like you said, and knowing it's all about the market too, making sure it's a little bit diversified, because yes, you are, if they don't get paid for what they're doing, you're not going to get paid for what you're doing. So a lot of great information there, Stewart. So Stewart, how can listeners learn more about you and your business, Harvard Grace?
Easiest way to go is to harvardgrace.com. There you can find lots of free resources, especially if you are a passive investor. There's some resources there for you guys. It'll cost you nothing but your email address. You can also poke around to contact us. You can find my Calendly link. And I do invite, in all sincerity, anybody, use that link, find some time, talk with me. I can talk with anybody almost any time about real estate, anytime you want. So lots of people do take me up on that, and it's a genuine offer.
Well, thank you so much for coming on today, and looking forward to connecting with you here in the near future.
Thank you, Charles. Thanks for having me.
Hi, guys. It's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.